Today's CPI report is going to be reported as a clean number. Headline inflation up 2.5% year over year. Core CPI up 0.3% month over month. Analysts will call it contained. The Fed will call it manageable. Financial television will spend 4 hours debating whether it changes the March rate decision, which it almost certainly does not. And every single one of those conversations will be missing the most important piece of context about today's inflation data. The February CPI was collected before February 28th. Economists say February's CPI data was collected before the start of the conflict and won't reflect the surge in energy prices. This data is from before the recent conflict in the Middle East broke out, so it's not going to give us a whole lot of information on how prices are starting to respond to that. That's going to be a March and April dynamic. JM Bullion. Read that again. Today's number, the number every analyst on financial television is treating as the current picture of American inflation, was collected before the war started, before oil hit $120, before Iraq cut production by 60%, before 150 tankers anchored outside a closed Strait of Hormuz, before the biggest single-week energy price surge since 1985. The CPI report landing today is a photograph of a house before the fire started, and they are asking you to use it to decide whether the house is currently burning. This is John A.G. here. Before we go one sentence further, I sell nothing. No course, no premium group, no Discord, no signal service, no newsletter behind a paywall. Zero. The raw data and the full analysis live here on this channel, and that will never change. If what you're about to hear changes how you read what's happening in these markets, subscribe and drop John A.G. here in the comments so I know exactly who's in the room. Because what I'm about to lay out is the complete picture of where silver stands on War Day 11, and why today's CPI print, while meaningless as a forward indicator, actually tells you something very important about what comes next. Part 1, the CPI blind spot, and why it changes everything. Headline CPI is expected to be up 0.3% from January to February, and 2.4% from the year prior. Core CPI, which excludes volatile food and energy prices, is forecast to rise 0.3% on a monthly basis, and 2.5% year over year. JP Morgan. Those numbers look benign. They look like inflation is moderating. They look like the Fed has room to breathe. And in the context of the data that was actually collected, data from January and early February, they may even be accurate. But here is the problem. The rise in oil prices adds to an already cost-exhausted consumer who has been grappling with inflationary pressures for years. Wednesday's CPI for February will help gauge the inflation picture prior to this recent geopolitical conflict and oil price surge, but we would expect this early March surge in oil prices to take some time to show up in the economic data. JP Morgan. Take some time to show up. That is the most important phrase in any economic analysis published this week, because what it means in practical terms is this. The Fed is walking into its March 18th meeting, 7 days from today, with the most stale inflation data it has received at a consequential moment in years. Even in the case of a cool CPI print, the Fed is in wait-and-see mode as it looks for clearer pricing signals following the Middle East conflict. The Fed is going to want to gather more information before adjusting policy. I think we're just too early, and there's still too little information out there. JM Bullion, a Federal Reserve that cannot move on rates because the data is 3 weeks behind the oil shock, is a Fed that is functionally paralyzed. And a paralyzed Fed, in an environment where oil has already spiked 40% in a single week and silver just jumped 6.25% in a single session, is not a neutral force. It is a force that amplifies the pressure building underneath the paper market rather than releasing it. The CPI today is not the story. The CPI that doesn't exist yet, the March and April readings that will finally capture what oil at $100 plus does to the prices of every good and service in the American economy, that is the story. And silver at $84 today is priced against the stale number, not the real one. Part 2, what silver's 6.25% session actually means silver fell to 83.70 per ounce on Tuesday, March 3rd, down another 7% on the day after losing nearly 5% on Monday, wiping out the entire safe haven premium built on the back of the U.S.-Israel strikes on Iran and the closure of the Strait of Hormuz. From Monday's opening spike above $96, the metal shed roughly 13% in just 48 hours, returning to the same sideways range that defined the entire month of February. Discovery alert. That 13% crash in 48 hours is the number that retail investors remember. That is the number that generated the panic sells, the margin calls, the silver is manipulated downward commentary that flooded every precious metals forum last week. And it is a real number. The crash happened. The pain was real. But here is what happened after it. Silver spent the following sessions rebuilding. Session by session, the physical demand floor absorbed every paper offer. And then yesterday, on the same day that the U.S. launched what the defense secretary called its most intense strikes inside Iran yet, silver posted a 6.25% single session gain. The strong volatility in the precious metals market and the increase in safe haven demand indicate that the silver price will likely break $120 in 2026 and move towards $150. The short-term price action for silver also shows strong bullish price action, as the silver price has been trading within an ascending broadening pattern since September 2025. CME Group. Now I want you to hold two things in your mind simultaneously. First, silver crashed 13% in 48 hours after the initial war spike. Second, silver recovered from that crash and posted a 6.25% session yesterday, while the war is still active on day 11. The crash was the speculative overlay unwinding, fast money in, fast money out. The recovery is something different. The recovery is physical demand absorbing every offer at every level. Those are two different market participants doing two different things, and the one that matters for where silver goes over the next 60 days is not the fast money. It is the buyers who showed up every single session on the way down and kept the price from collapsing below 79. Part 3. War Day 11. What the timeline actually looks like. Strikes began early Saturday, February 28th. U.S. and Israeli forces hit over 2,000 targets inside Iran, missile sites, Navy bases, and the Natanz nuclear facility. Al Jazeera casualty report confirms Khamenei was killed on day 1. CNN confirms Iran retaliated fast. Missiles struck Israel, Lebanon, and Gulf states, including the UAE, Qatar, Kuwait, and Bahrain. Naval traffic through the Strait of Hormuz, 20% of global oil, stopped cold. President Trump told reporters the campaign could last 4 to 5 weeks. Trading key 4 to 5 weeks from February 28th puts the end of active operations somewhere between March 28th and April 11th. We are on day 11 of that timeline. We are approximately 1/4 of the way through what Trump himself projected. And in those 11 days, here is what has happened to the physical infrastructure that silver depends on. Gold fell 7% and silver crashed 19% from Monday morning's brief 4-week highs as war-fueled energy costs hit stocks, bonds, and base metals. The dollar rose 1.1% on its DXY index, its sharpest gain since May last year. CME Group silver down 19% from the war spike highs. That is the headline. But pull back the lens. Silver on February 27th, the last trading day before strikes began, was sitting around $88. Silver today is at $84 and recovering. The net movement of silver from the day before the war started to day 11 of the war is approximately negative 4%. Through the biggest energy shock since the 1973 oil embargo, through the death of Iran's supreme leader, through the closure of the world's most important oil choke point. Negative 4% net on an 11-day war is not a silver collapse. It is silver refusing to collapse. And there is a specific structural reason for that refusal that no amount of dollar strength or speculative deleveraging changes. Part 4. The 3 transmission channels. Nobody combined today. Let me show you exactly how $100 oil, which is where WTI is trading right now after pulling back from 120, transmits into the silver market through 3 specific channels. Not 1, not 2, 3 simultaneously. And today's CPI report captures none of them. Channel 1, the cost floor. Every ounce of silver pulled from the ground requires diesel for drilling equipment, natural gas for smelting, and petroleum-based chemicals for hydrometallurgical processing. When oil moves from $60 to $100, the all-in sustaining cost of silver production rises by approximately $6 to $9 per ounce for the average primary silver miner. Major silver producer Fresnillo reported earnings before interest, tax, depreciation, and amortization of $280 billion for the 12 months ended December 31st, 2025, up more than 80% over the previous year, allowing a total payout of $950 million to shareholders. One India. Fresnillo's 2025 margins expanded because silver prices rose faster than costs. In 2026, with oil at $100 plus, the cost side of that equation is moving aggressively upward. The production margin that supported record silver output in 2025 narrows with every week that oil holds above $90. New mine development becomes economically marginal. Existing producers manage carefully. The supply response to higher silver prices gets slower and more expensive. Channel 2, the inflation trap. A lasting Iran war could lead to a more sustained increase in oil prices. While analysts expect the conflict to be short-lived, they think high oil prices and a worsening economic outlook, particularly for the jobs market, could provoke a rate cut. JM Bullion. The Fed is trapped between 2 bad options right now. You cannot cut into sustained $100 oil. That is 40% energy inflation feeding directly into every downstream price. You cannot hike into a war-driven growth slowdown with unemployment already edging above 4.4% and February NFP negative 92,000. So the Fed sits, it waits. A majority of market participants, about 97%, anticipate interest rates staying in the 3.50% to 3.75% range. JM Bullion. A Fed that cannot move is a Fed that cannot provide the rate cut tailwind the paper market has been pricing. But it is also a Fed that cannot provide the hawkish ceiling that would justify the dollar strength currently suppressing silver. The paralysis cuts both ways, and when the March and April CPI readings arrive, with $100 oil fully baked in, the Fed will be forced to choose which bad option is less bad. That choice, whichever direction it goes, is a catalyst for silver movement. Channel 3, the shipping mechanism. Naval traffic through the Strait of Hormuz, 20% of global oil, stopped cold. Trading key, those ships do not carry only oil. Industrial metals, copper concentrate, silver refinery feedstock, all of it moves through the same choke point. When shipping insurance disappears for Hormuz transit, it disappears for every commodity aboard every vessel. The supply chain disruption that is strangling oil is running through the same logistical infrastructure that moves physical silver between the world's largest producing and consuming nations. Today's CPI number contains none of this. Not the cost floor escalation, not the inflation trap tightening, not the shipping disruption compounding. All three of these channels are post-February 28th dynamics. They will begin showing up in data in March and April. They will fully manifest in May and June. Silver at $84 today is priced against data that preceded all three of them. Part 5, the comic structure that the war cannot reset. Here is what the war changed and what it did not change. The war changed. Speculative positioning, volatility, geopolitical risk, premium, oil prices, shipping costs, and the Fed's policy visibility. The war did not change. The 6 consecutive years of structural silver deficit. The 64% drain of COMEX registered inventory since 2020. The 74.38 million ounces physically delivered from COMEX in the first 60 days of 2026. The Shanghai physical premium running persistently above Western spot. The fact that analysts at major institutions now forecast silver potentially reaching $100 to $150 per ounce in 2026, with the US-Iran conflict serving as a potential catalyst that could accelerate these price targets. Financial content. The structural deficit was building before February 28th. The Silver Institute says the market recorded a structural deficit in 2024 and is forecast to remain in deficit in 2025 and 2026. Total silver demand reached about 1.16 billion ounces in 2024, while supply remained insufficient to meet consumption. Industrial demand has been especially strong, supported by solar applications, vehicle electrification, grid investment, electronics, and AI-linked uses. Light finance. The war did not create that deficit. The war did not create the COMEX inventory drain. The war did not force 74.38 million ounces of physical delivery in January and February. Those dynamics were already in motion. What the war did was compress the timeline on which those dynamics converge with a paper market that is running out of physical metal to deliver. Part 6. The honest bear case. I always give you both sides, because anyone who only gives you one direction is not educating you. They are recruiting you. Bear argument 1. The war resolves faster than expected. Markets price in quick wins. If Trump's 4 to 5 week timeline holds and Iran's regime cracks without closing Hormuz for good, we could see a sharp pullback. Gold likely holds above $5,200 even on de-escalation news. Silver stays the wild card. Bigger upside if industrial demand holds, bigger drops if recession fears spike. Trading key. If ceasefire signals emerge this week, the war premium in silver evaporates quickly. We have already seen this movie once. Silver spiked to $96 on the war open, then crashed 13% in 48 hours as the initial shock was absorbed. A diplomatic development could produce an identical move from current levels. Bear argument 2. If CPI and PCE show that core inflation, particularly in services and shelter, continues to cool, markets are likely to respond positively. Treasury yields could decline as rate cut expectations are revived, the dollar may soften, and equities could find support. JM Bullion. A soft CPI today, which the data suggests is likely given the pre-war collection window, could paradoxically be used by paper sellers as a narrative window. Inflation contained, Fed on hold, no urgency for hard assets. That is a 2-week trading thesis that the paper market can run regardless of what the physical vault data says. Bear argument 3. Silver's industrial demand is vulnerable to an oil-driven recession. If the conflict hurts global growth or manufacturing, silver's industrial exposure can become a drag even if gold remains strong. That is one of the main risks for bullish silver forecasts. Light finance. The same oil shock that pushes up silver's monetary value pushes down the global manufacturing activity that consumes 60% of annual silver supply. These two forces can pull the price in opposite directions simultaneously, which is exactly why silver crashed harder than gold in the initial war sell-off. These arguments are real. They deserve weight. The bear case is not irrational. But here's what the bear case cannot address. The The CPI blind spot I showed you in part 1 applies equally to the bullish and bearish forecasts. Every analyst model built on current inflation data is working with numbers that predate the oil shock. The question is not whether today's CPI is hot or cold. The question is what the April CPI looks like when $100 oil has had 6 weeks to feed through into every downstream price. That number does not exist yet, and until it does, anyone telling you with confidence where silver goes from here is working with an incomplete data set. Part 7. The 3 scenarios. Through end of March. Let me give you honest probability assessments for the 3 scenarios that matter between now and March 31st. Scenario 1, the range holds. Most likely, silver consolidates between $79 and $92 through the first 2 weeks of March. Today's soft CPI gives paper sellers a brief narrative window. The Fed holds at March 18th as expected. War continues but without dramatic new escalation. The COMEX delivery drain keeps running at its current pace. Silver ends March somewhere in the $85 to $95 range. Not explosive, but the physical floor continues absorbing every flush. The real move is being deferred to April when the first post-war CPI lands and the Fed is forced to respond to actual inflation data rather than pre-war data. Scenario 2, war escalation forces the move. Possible. A specific escalation, Hormuz completely sealed for more than 30 days, Saudi infrastructure attacked, U.S. carrier group engagement, produces a flight to safety bid that overwhelms the paper selling mechanism. The silver price will likely break $120 in 2026 and move towards $150. CME Group. In this scenario, the CPI blind spot becomes irrelevant because the physical market reprices independently of what government data says about inflation. Scenario 3, ceasefire and flush, possible but short-lived. A confirmed ceasefire announcement produces a rapid unwinding of war premium. Silver tests $75 to $79. The speculative overlay gets flushed again. But the structural COMEX drain does not stop. The Shanghai premium does not close. The 6th consecutive deficit year does not reverse. Within 30 to 60 days of a ceasefire, the physical supply story reasserts itself, just as it did after every previous disruption event in this cycle. The closing data stack. Here is exactly where everything stands as of Wednesday, March 11, 2026. No editorial. Pull every number yourself. February CPI released today. Headline CPI up 2.4% year over year. Monthly increase 0.4% prior to seasonal adjustment. CBS News data collected before February 28th war start does not reflect oil shock. Silver, $84 and recovering, up 6.25% in yesterday's session, down approximately 4% net since the day before the war started. Silver broke out above $93 recently with proximity to the critical $95 resistance. The metal is positioned for potentially significant further gains if the conflict persists or escalates. Financial content war, day 11. Trump projected 4 to 5 weeks of operations. Trading key approximately 1 quarter through the projected timeline. COMEX registered silver inventory, 81.2 million ounces, down 64% since 2020. 74.38 million ounces delivered in first 60 days of 2026, highest 2-month delivery total in exchange history. Bank of America analysts wrote in a recent note, a lasting Iran war could lead to a more sustained increase in oil prices, which could provoke a rate cut. JM Bullion Fed meeting, March 18th, 7 days from today. 97% of market participants anticipate rates unchanged. JM Bullion March and April CPI, not yet collected, will be the first readings to capture $100 plus oil. Expected release dates April 11th and May 13th. Pull the BLS release yourself. It is free and public. Check the COMEX Daily Warehouse Report. Watch the Fed's statement on March 18th specifically for any language about energy price pass-through into inflation expectations. And watch whether today's soft CPI gives paper sellers a narrative window into silver. Because if it does, the physical demand floor at $79 to $80 is where you will see whether this market's structural buyers are still there. They have been there every single session on the way down so far. The data suggests they will be there again. If this changes how you read what is unfolding, hit the like button. Share it with someone who thinks today's CPI number tells the complete inflation story. Subscribe if you haven't. Because when the first post-war CPI lands in April and the real inflation picture becomes impossible to explain away, this channel is where the full breakdown lands first. Unfiltered, unsponsored, free. Drop John AG here in the comments. Not because I am counting, because it tells me you sat through every data point, every bearish counter-argument, and every question this video raised, and you are still here. That is the audience this channel is built for. This is financial warfare education. It is not investment advice. Invest with logic, never with emotion, never with impulse decisions. Be smart, stay vigilant. OG John. AG signing out. The CPI captured the house before the fire. The vault drain is the fire. Watch which one the market prices first.